The money is already in your account. Real money. More than you have ever had sitting in one place at one time, and every day it just sits there while you do nothing. Because this morning the headline said it again. Record high. All-time high. The highest price anyone in the history of the world has ever paid for the thing you were about to buy. And every instinct you have is screaming one sentence at you, in your own voice. You are about to be the idiot who bought at the top. So you wait. A week. Then a month. Then a year. You are not alone in that room. According to the investment company Institute, U.S. money market funds are holding close to $8 trillion right now. Most of that is institutional, and it does earn interest. It isn't dead money, and I'm not going to pretend it is. But a real slice of it belongs to somebody exactly like you, staring at a green screen, waiting for a better day to arrive. I went looking for what actually happened to the people who bought on the days that felt worst. Over and over. For 75 years. The answer is a number, and the number is 0. I'll show you what it counts. Here's the thing nobody says out loud about record highs. Think about a kid growing up. There's a door frame somewhere with pencil marks on it, and every few months that kid stands against it and there's a new mark, higher than the last one. Every single one of those marks is an all-time high. The tallest that child has ever been in the entire history of that child. Nobody looks at that door frame and panics. Nobody says, well, this is clearly unsustainable. You don't treat the mark as a warning. You treat it as the completely ordinary evidence that something is growing. A record high in a broad stock index is a pencil mark on a doorframe. It's what growth looks like from the inside. It only feels like a cliff edge because you're standing on it holding your own money. The high was never the danger. The waiting was. That sentence has boundaries, and I'm going to draw every one of them before this video is over. But it's the right place to start. I'm going to do something specific here. I'm not going to tell you the market is safe, and I'm not going to tell you it's about to crash, because nobody making a video on the internet knows either of those things, and the ones who claim they do are selling you something. What I am going to do is open the actual historical record, run the actual arithmetic, and show you what happened after the days that felt like the worst possible time to buy. Not a feeling about it. The number, and then the fine print on the number, because the fine print is where most people telling you this story get sloppy. This channel does the boring version of this every week. Let's start with what's happening in your head, because I think you'll recognize it precisely. You open the app. Green. Everything is green. The number at the top of the screen is the biggest it has ever been, and underneath it there's a headline with the word record in it. And instead of feeling good, you feel a small cold thing behind your ribs. You think, this can't last. Now notice something. You don't think that when the market is down. When the market is down, you think about how much you've already lost. When the market is up, you think about how much you're about to lose. Both thoughts, same subject. And the subject is not the market. The subject is losing. That's not a personality flaw, and it isn't a lack of discipline. One of the most influential findings in behavioral economics is that losses tend to weigh more heavily on us than equivalent gains. In 1979, Daniel Kahneman and Amos Tversky published a paper in Econometrica called Prospect Theory that gave the effect a shape. In many of the commonly cited experiments, it lands somewhere around twice as strong, though the exact size varies a lot with context, and researchers are still arguing about how universal it really is. You don't need the precise multiplier. You need the direction. Staring at that screen, the downside gets weighted heavier than the upside, and your brain quietly concludes that not moving is the safe option. There's a second thing happening, and it's sneakier. The moment you look at that record number, it becomes your reference point, which means the day you buy at an all-time high, you've guaranteed that every future you can picture contains a sentence where you paid more than anyone had ever paid. Your brain does not want to be in that sentence. So it invents a solution that sounds responsible. Wait for a dip. Buy the discount. Be patient. That would be excellent advice if all-time highs were rare. They are not rare. In RBC Global Asset Management's dataset, running on Bloomberg data from January 1950 through August of 2025, the S&P 500 set 1,325 all-time highs. Across those 75 years, that averages more than 17 a year, roughly one every 3 weeks. In the first half of 2026 alone, the index set 24 more. Sit with that. The event you're treating as a rare and dangerous signal shows up about as often as your paycheck. If a warning light goes off 17 times a year for 75 years, at some point you have to consider that it isn't a warning light. It's just the dashboard. And I want to be careful about what I'm not saying, because this is where these videos usually go stupid. I'm not saying a record high means the market will keep going up. It does not mean that. What the history says is narrower and more useful. The fact that the market is sitting at a record has not given a consistent timing signal in either direction. Here's how you can see it. RBC took every 5-year stretch that began on a day the S&P 500 closed at an all-time high and averaged what those stretches returned. Then they did the same thing for 5-year stretches beginning on any trading day at all. The windows that started at a record averaged 10.5% a year. The windows that started on any day averaged 11.4. Now read that carefully because it is not what most people say it is. 10.5% is not the return of some maximally unlucky investor who nailed every top. A record high isn't necessarily even a bad day to buy. Records tend to arrive in clusters, and a great many of them were followed almost immediately by more records. What that number is the average outcome of starting on the day that feels worst. And the day that feels worst came in 0.9 of a percentage point behind everything else. You've been sizing a 0.9 of a point problem like it was a 50% problem, because the downside gets weighted heavier on the way in. Now let's push harder, because there's a more sophisticated version of this fear and it deserves a real answer. The sophisticated version goes, fine, the averages are close. But buying at a peak means I'm more likely to end up underwater. More likely to watch it fall below what I paid. Nick Maggiulli, the chief operating officer at Ritholtz Wealth Management, ran exactly that test on the Dow Jones going back to 1915 and published the code alongside it. If you bought on a completely random trading day, the odds that you'd eventually see a lower closing price at some point in the future were 96.7%. If you bought specifically at an all-time high, those odds were 97.0%. 0.3% apart. Statistically, that's noise. It's the same number wearing a different hat. Which means the specific thing you're afraid of buying, then watching it go below your price, has historically been extremely common either way. It isn't a consequence of bad timing. It's a consequence of investing at all. So let's put a dollar figure on it because a percentage doesn't scare anybody and a dollar amount does. Take $10,000 at 10.5% for 5 years. You end up with $16,474. Now the 11.4 version. Same 10,000, same 5 years. 17,156. $682. That's the distance between starting on the day that feels worst and starting on an average day. And I know the objection. Stretch it out. Compounding turns a small gap into a canyon. So stretch it out. Same 10,000, same 2 rates, 10 years. $27,141 against $29,434. Over a full decade, the gap is about $2,300. Hold that next to what you've actually been doing because that's the real comparison. Not good timing versus bad timing. Bad timing versus nothing at all. The bad timing version still ends the decade around $27,000. The nothing at all version ends the decade at $10,000 plus whatever interest it earned, which is a lot closer to where it started. Now here's the part 1 made this video for. RBC looked forward from every one of those record highs and asked, how often were you down more than 10% a year later? 9% of the time. Then they extended the window to 5 years. And in that dataset, the number of those record highs that left you more than 10% down at the 5-year mark was 0. I have to be precise about what that word covers because 0 is exactly the kind of word people run off with. It does not mean nobody ever lost money. It does not mean the ride was calm. Some of those 5-year stretches contained absolutely brutal drops in the middle. It does not mean losses between 0 and 10% never happened, because they did. And it is not a promise about the future. It means one specific thing. Measured at the 5-year mark, none of those record high starting points finished more than 10% underwater. That's the mechanism, and I'm going to name it so you can carry it out of here. Call it the 0 rule. The 0 rule says the record itself isn't the variable deciding your outcome. The horizon is. Stretch the window and the historical damage from starting at a high shrinks toward nothing, because what that fear was actually measuring was never the market. It was how soon you were going to look. The high was never the danger. The waiting was, I want to tell you about somebody. She's a composite. I built her out of a pattern I've watched play out constantly, but every move she makes is a move real people make. Call her Priya. 31. Hospital administration. Her company got acquired, and the equity she barely remembered signing for turned into $40,000 in her checking account. The first real money of her life. She did everything right. She read for 3 weeks. She learned what an index fund was. She opened the account, funded it, and sat there with her finger over the button. Then she looked at the chart. The market was at a record high. Of course it was. It's at a record high about 17 times a year. And Priya thought the completely reasonable thought that everybody thinks. Not today. Not at the top. I'll wait for a pullback, get in at a better price, and I'll have been smart about it. Here's what that decision actually was, and she couldn't see it at the time. It wasn't a decision to wait. It was a decision to make a prediction that a specific price she liked better would show up inside a window of time she never actually defined. She'd made a forecast, and she didn't know she'd made one, because it was disguised as caution. The pullback came. Of course it did. About 4% in the fall. And Priya didn't buy. Because a 4% dip doesn't feel like an opportunity when you're scared. It feels like the first 4% of a bigger one. That cold thing behind the ribs doesn't say by now, it says, see, I told you, and it gets louder, not quieter, when the thing you feared starts happening. So she waited for the real one. The market went back up, set new records, and she waited some more. And by then she had a second problem. Every price on the screen was higher than the one she'd refused, and buying now meant admitting the wait had cost her something. That's not a math problem anymore. That's an identity problem. She had become a person who was waiting, and buying meant being wrong out loud. 19 months. That's how long the $40,000 sat there while she was, in her own description, being careful. It wasn't a disaster. It earned some interest. But it also spent 19 months not doing the job she had decided she wanted it to do, and that kind of cost never shows up on a statement, which is exactly why it's so easy to keep paying it. What broke it wasn't a market call. Nobody rang a bell. What broke it was Priya running into the same numbers you just heard. That starting on the days that felt worst had historically cost less than a percentage point a year, and that in 75 years of that data, none of those starting points finished a 5-year stretch more than 10% down. She had spent 19 months bracing for a gap that history says has been much smaller than the one she was picturing. She put the money in on a Tuesday. The market was, naturally, near a record high. She told a friend afterward that the strangest part was how completely nothing happened. No lightning, no crash, just a number in an account doing what numbers in accounts do, which is mostly nothing on any given day and quite a lot over a decade. Now, everything I just told you has boundaries, and if I don't draw them, I'm doing the exact thing I said I wouldn't. First boundary, and it's the biggest. This is about the horizon, not about the high. In Maggiulli's data, over the following year the S&P 500 actually averaged less when it was near an all-time high than when it wasn't, 8.3% against 10.1. Over 3 years it flips the other way. That inconsistency is the honest conclusion. No reliable signal either direction. But it also means that if there's a meaningful chance you need this money inside 5 years, nothing in this video makes stocks appropriate for that goal. The zero rule is a statement about time. You have to actually have the time. Second boundary. This is about a broad index of 500 companies, not a single stock at its record high and not a concentrated bet on one asset. A broad index is diversified and periodically replaces companies that no longer meet its criteria, and its recovery leans on earnings growth across hundreds of businesses. One company has no equivalent protection, can simply be over. Third boundary, and this one should genuinely bother you. Everything above is the record of one index over one 75-year stretch, in a country that produced one of the strongest major equity records of the period. Japan's Nikkei 225 peaked in December of 1989 and did not close above that level again until February of 2024, 34 years. And the American Dow took roughly 25 years to regain its 1929 peak. Both of those are price index comparisons before reinvested dividends. An investor collecting and reinvesting dividends would have recovered sooner. But not 34 years sooner. So when I say it has never happened, hear exactly what I'm claiming. It hasn't happened in this index, in the window we have data for. That's a strong historical pattern. It is not a law of physics, and anyone selling it as one is lying to you. All right, you know what the fear is and what it has historically cost. Here's what to do with that. 1. Before the market question, the boring questions. Emergency cash you can actually reach and high-interest debt. Neither of those cares what the chart did today, and both of them beat this decision in line. 2. Separate the two questions you've been asking as one. Is this a good time to invest? And when do I need this money? Are completely different. And only the second has an answer you can actually know. If there's a real chance you need it inside 5 years, the record high isn't your problem, the timeline is. 3. If you're frozen, split the entry. Fixed amount, fixed schedule, decision removed from you. Understand what you're buying, though historically, spreading the entry in has usually returned slightly less than putting it in at once. Simply because the market has risen more often than it's fallen. You're not buying a better return. You're buying the ability to actually go through with it. That's worth real money to a person who would otherwise do nothing. Just be honest that it has a price. 4. Write down the price you're waiting for and the date it has to arrive by. Not in your head. On paper with a date. Most people find out in about 4 seconds that they can't finish that sentence, and that's the whole lesson. You weren't waiting for a price. You were waiting to feel differently. So let's put it back together. The record high feels like a warning because the downside gets weighted heavier than the upside, and because that record price becomes the reference point you measure yourself against forever. That's Kahneman and Tversky working exactly as designed. But the record itself hasn't carried a consistent signal. It shows up 17 times a year. 5-year stretches starting at a record averaged 0.9 of a point behind everything else. And of the 1,325 record highs in that dataset, the number that finished 5 years more than 10% down is 0. Not zero risk. 0 of those. The boundaries stand. 5 years or more, a broad index, one market's history. Japan's investors waited 34 years. None of this is a guarantee, and I'm not qualified to tell you what to do with your specific money. Nobody making a video for strangers is. But if you've been sitting on cash waiting for permission from the chart was never going to give it to you. There is no green light coming. There has never been a day that felt obviously safe in advance, and every one of those days is now a pencil mark on a doorframe that somebody was too nervous to stand next to. Priya spent 19 months waiting to feel a way she was never going to feel. And the feeling didn't show up after she invested either. Nothing showed up. That's the whole secret. The high was never the danger. The waiting was.